In the early hours of a tense diplomatic standoff, far from the trading floors of New York or the marble corridors of Washington, a familiar but often misunderstood battleground once again moved to the center of global power politics: Venezuela's oil fields. What appeared on the surface as a regional intervention wrapped in language of sanctions, humanitarian concern, and energy security carried implications far larger than any single country in Latin America. Beneath the headlines, this moment exposed a fracture in a monetary order that has governed the world for more than half a century, an order built not on treaties alone, but on oil, dollars, and force. To understand why Venezuela suddenly mattered again, one must look beyond geopolitics and into the machinery of global money itself. For decades, the petrodollar system has functioned as the silent engine of American financial dominance, allowing the United States to finance deficits, project power, and absorb shocks that would cripple any other nation. Oil exporting countries sold energy in dollars, recycled those dollars back into U.S. debt, and in doing so, reinforced the dollar's role as the world's reserve currency. This arrangement was never purely economic. It was enforced through alliances, military guarantees, and, when necessary, intervention. Venezuela, sitting atop the largest proven oil reserves on Earth, has long represented both an asset and a threat within this system, depending on who controlled its government and where its oil was sold. What makes the current moment different is not merely Venezuela's internal crisis or its strained relationship with Washington, but the broader context in which this confrontation is unfolding. Across the globe, central banks are quietly reducing their dependence on the dollar, energy producers are experimenting with non-dollar settlement mechanisms, and geopolitical rivals are openly questioning the sustainability of an order dominated by a single currency. In this environment, any move involving oil-rich states takes on amplified significance because oil remains the bloodstream of industrial civilization. When oil flows change, money flows follow. And when money flows shift, power is never far behind. The renewed focus on Venezuela, therefore, cannot be separated from a growing anxiety in Washington about the durability of dollar supremacy. The petrodollar has survived wars, crises, and financial panics, but it has done so by constantly adapting and, at times, by applying pressure where resistance emerged. From the Middle East in the 1970s to Iraq in the early 2000s, challenges to dollar-based oil trade have often coincided with political or military confrontation. Venezuela's defiance, combined with its alignment with alternative financial blocs, revives an uncomfortable historical pattern that policymakers understand all too well, even if it is rarely acknowledged in public discourse. At stake is not simply whether Venezuela sells oil to one buyer or another, or whether sanctions succeed or fail in the short term. What is at stake is the precedent set when a major energy producer operates outside the dollar system at a time when others are watching closely. If Venezuela can survive, or even partially thrive, while settling oil trades in alternative currencies, it signals to other producers that the costs of defection may be lower than previously assumed. In a system built on collective belief and compliance, perception can be as powerful as policy. This is why financial markets react so sharply to what might otherwise appear as regional news. Currency traders, bond investors, and central banks are not studying Venezuela for its domestic politics alone, but for what it reveals about the future architecture of global finance. The dollar's strength has always rested on a combination of trust, necessity, and lack of viable alternatives. When necessity weakens and alternatives multiply, trust becomes fragile, and fragility in monetary systems tends to spread faster than confidence. The intervention narrative also exposes a deeper contradiction within the global order. On one hand, the dollar-based system claims neutrality, stability, and efficiency as its core virtues. On the other, it relies on coercive tools such as sanctions, asset freezes, and financial exclusion to maintain compliance. Venezuela has been a laboratory for these tools, subjected to some of the most extensive financial restrictions in modern history. The question now facing the world is whether such measures reinforce the system's authority or accelerate the search for ways around it. To grasp the significance of this moment, one must step back and see Venezuela not as an isolated case, but as a pressure point where energy, money, and geopolitics converge. The petrodollar is under strain not because of a single decision or a single country, but because the conditions that once made it inevitable are changing. Technology, multipolar power structures, and strategic mistrust are reshaping incentives across the global economy. Venezuela, once written off as a failed state, has become a symbol of a much larger struggle playing out beneath the surface of daily news. This story, therefore, is not simply about oil shipments or sanctions waivers, but about the future of the monetary system that defines modern life. It is about how power is exercised when control over money is challenged, and how far dominant nations are willing to go to defend arrangements that benefit them. As Venezuela re-enters the global conversation, the petrodollar's foundations are being tested in real time, and the outcome will resonate far beyond Caracas or Washington. To understand where this struggle leads, we must first understand how it began. The roots of the petrodollar system stretch back to a moment of profound instability in the global monetary order when the post-war financial architecture began to crack under its own weight. In August 1971, President Richard Nixon announced the suspension of the dollar's convertibility into gold, effectively ending the Bretton Woods system that had governed international finance since 1944. This decision was not framed as the collapse of a system, but as a temporary measure to protect American interests, even as it unleashed uncertainty across global markets. With gold no longer anchoring the dollar, the United States faced a critical question. What, if anything, would now give global actors a reason to hold dollars at scale? The answer emerged from an unlikely convergence of energy dependence and geopolitical necessity. By the early 1970s, industrial economies were increasingly reliant on imported oil, while oil-producing states, particularly in the Middle East, had consolidated their power through organizations like OPEC. The 1973 oil embargo exposed the vulnerability of Western economies, sending inflation soaring and plunging governments into crisis. For Washington, the solution was not merely to secure oil supplies, but to bind the global energy trade to the dollar in a way that would recreate external demand for U.S. currency. This binding took shape through a series of strategic agreements, most notably between the United States and Saudi Arabia. In exchange for military protection, arms sales, and political backing, Saudi Arabia agreed to price its oil exclusively in U.S. dollars and to recycle surplus revenues into American financial markets. Other OPEC members followed, not because they were forced directly, but because participation in the dollar-based oil market became the path of least resistance. Oil, the most traded commodity in the world, thus replaced gold as the functional anchor of the dollar. The implications of this arrangement were immense and often poorly understood outside elite policy circles. Every country needing oil now needed dollars, which meant holding dollar reserves, earning dollars through trade, or borrowing them from dollar-based financial institutions. This created a constant, self-reinforcing demand for U.S. currency and Treasury debt, allowing the United States to run persistent trade and budget deficits without facing the immediate penalties that would afflict other nations. In effect, the petrodollar system transformed energy dependence into monetary dependence. As this system matured, it became embedded not just in trade practices, but in the institutional framework of global finance. Banks, clearing systems, shipping insurers, and futures markets all evolved around dollar-denominated oil transactions. The infrastructure itself became a barrier to exit, making alternatives costly and risky, even for nations that might prefer independence. This inertia gave the petrodollar a resilience that outlasted administrations, wars, and economic cycles, turning it into a structural feature of globalization. Yet from its inception, the system carried an inherent tension. It required oil producers to trust that holding dollar assets would preserve their wealth, even as inflation and monetary expansion periodically eroded purchasing power. It also required political alignment with Washington, or at least acquiescence, to ensure continued access to markets and protection. Countries that challenged these assumptions, whether by experimenting with alternative pricing or by aligning with rival powers, often found themselves facing diplomatic isolation or economic pressure. Venezuela entered this story as both participant and outlier. During the latter half of the 20th century, it was a reliable oil supplier integrated into the dollar system, its revenues flowing through U.S. banks and its elites deeply connected to Western financial networks. Oil wealth funded development projects, and SUS attained a degree of stability even as underlying inequalities persisted. The petrodollar worked for Venezuela, but it also locked the country into a dependency on oil exports and external finance that would later prove destabilizing. By the end of the Cold War, the petrodollar appeared unassailable, reinforced by the collapse of the Soviet Union and the expansion of U.S.-led globalization. Yet, beneath this apparent triumph lay unresolved contradictions, particularly for countries like Venezuela, whose economic fate was tied almost entirely to oil priced in a currency they did not control. As new political forces emerged in Caracas, these contradictions would move from abstract economic concerns to the center of national strategy. The stage was set for a confrontation that would test not only Venezuela's resilience, but the flexibility of the petrodollar system itself. The turning point in Venezuela's relationship with the petrodollar system arrived at the end of the 20th century, when deep social inequality and economic volatility converged into a political rupture. In 1998, Hugo Chavez was elected president on a platform that openly rejected the neoliberal economic model that had dominated Latin America since the 1980s. Chavez framed Venezuela's oil not merely as a commodity, but as a sovereign resource that had been mismanaged in the service of foreign interests and domestic elites. This ideological shift would soon place Venezuela on a collision course with the financial architecture that underpinned dollar-based oil trade. One of Chavez's earliest moves was to reassert state control over Petróleos de Venezuela, or PDVSA, the national oil company that had increasingly operated as a semi-autonomous entity aligned with international markets rather than domestic priorities. By tightening government oversight and redirecting oil revenues toward social programs, the administration disrupted long-standing relationships with foreign investors and U.S. energy firms. These changes were not simply administrative. They signaled that Venezuela was willing to challenge the unwritten rules of the petrodollar order. Oil would still be sold in dollars, but the political alignment that sustained the system was beginning to fray. As oil prices surged in the early 2000s, Venezuela gained both confidence and leverage. High prices provided fiscal breathing room, allowing Caracas to pursue a more independent foreign policy while cushioning the economic impact of confrontation with Washington. Chavez openly criticized U.S. monetary policy, questioned the legitimacy of dollar dominance, and deepened ties with countries seeking alternatives to American-led globalization. These alliances were not yet a direct threat to the petrodollar, but they laid the groundwork for experimentation outside its boundaries. The failed coup attempt against Chavez in April 2002 marked a dramatic escalation in tensions. While the precise role of external actors remains a subject of scholarly debate, the episode reinforced the perception within Venezuela's leadership that control over oil and money invited foreign intervention. The subsequent oil strike and lockout at PDVSA crippled production and caused massive economic damage, but it also hardened the government's resolve to reduce vulnerability to external pressure. From this point forward, monetary sovereignty became inseparable from political survival in Caracas. In the years that followed, Venezuela began exploring mechanisms to bypass traditional dollar-based financial channels. Oil for goods agreements, bilateral barter arrangements, and regional payment systems were promoted as ways to reduce reliance on U.S. banks and clearing networks. China and Russia emerged as critical partners, offering financing and technology in exchange for long-term oil supply commitments. Although many of these deals were still denominated in dollars, they weakened the centrality of Western financial intermediaries. The global financial crisis of 2008 further validated Venezuela's skepticism toward the dollar-centric system. As Wall Street institutions collapsed and the Federal Reserve expanded its balance sheet on an unprecedented scale, Caracas argued that the crisis exposed structural flaws in American financial stewardship. For oil exporters, the spectacle of massive monetary expansion raised uncomfortable questions about the long-term value of dollar reserves. Venezuela used this moment to intensify its rhetoric against what it described as an unsustainable and unjust monetary order. However, structural weaknesses within Venezuela's own economy limited its ability to fully escape the petrodollar framework. Chronic underinvestment, mismanagement, and declining production capacity eroded the country's oil output, even as global demand continued to grow. The reliance on oil revenues remained absolute, leaving the state vulnerable to price fluctuations and external shocks. This paradox meant that Venezuela simultaneously sought independence from the dollar system while remaining deeply exposed to its dynamics. By the time Nicolás Maduro assumed the presidency in 2013, Venezuela's challenge to the petrodollar had shifted from ideological defiance to existential struggle. Falling oil prices, mounting debt, and increasing sanctions tightened the constraints on economic maneuverability. Yet, it was precisely under these pressures that experimentation with non-dollar oil trade accelerated, not as a grand strategy, but as a necessity for survival. What began as a political statement was becoming a practical test of whether a major oil producer could function outside the gravitational pull of the dollar. To understand why Venezuela's struggle reverberates far beyond its borders, it is necessary to unpack how the petrodollar system functions, not as a treaty, but as a mechanism embedded deep within global finance. At its core, the system links energy consumption to dollar demand through a closed loop of trade, reserves, and reinvestment. Oil importing nations must acquire dollars to purchase energy, which pushes them to export goods, borrow, or draw down reserves denominated in U.S. currency. Those dollars then flow back into American financial markets through treasury purchases, bank deposits, and asset investments, reinforcing the dollar's central role. This mechanism grants the United States what economists have described as an exorbitant privilege, The ability to finance deficits at lower cost and with fewer constraints than any other nation. When global demand for dollars rises, U.S. borrowing becomes easier, not harder, even in periods of fiscal stress. Oil is critical to this dynamic because it is universally required and continuously traded, creating a baseline demand for dollars that is largely independent of U.S. economic performance. The petrodollar thus acts as a stabilizer for American power, smoothing over imbalances that would otherwise trigger currency decreases. Venezuela's attempt to operate outside this loop exposes the system's vulnerabilities. When oil is sold in alternative currencies, even on a limited scale, the closed circuit begins to leak. Importers no longer need to hold as many dollars. Exporters diversify reserves, and financial intermediaries outside the U.S. gain relevance. Individually, these shifts appear marginal, but collectively, they weaken the network effects that sustain dollar dominance. This is why the response to such experimentation is often swift and severe, aimed at discouraging imitation as much as correcting behavior. In recent years, these dynamics have intensified as technology and geopolitics converge. Digital payment systems, bilateral currency swap lines, and regional clearing mechanisms reduce the technical barriers to non-dollar trade. At the same time, sanctions regimes have expanded dramatically, transforming access to the dollar system into a political instrument. For many countries, Venezuela's experience serves as a warning not only about the risks of defiance, but also about the dangers of overdependence on a system that can be weaponized. The parallel to today's global environment is striking. Energy markets are fragmenting as producers and consumers seek greater insulation from geopolitical shocks. China has increased oil purchases settled in yuan. Russia has redirected exports toward non-Western markets, and several Gulf states have publicly signaled openness to diversified settlement arrangements. None of these moves alone dismantle the petrodollar, but together they erode the assumption that dollar pricing is inevitable. Venezuela's role in this shift is less about volume and more about symbolism, demonstrating that alternatives are possible under pressure. Financial data underscores this gradual change. Central banks have reduced the dollar's share of global reserves over the past decade, reallocating toward gold and other currencies. While the dollar remains dominant, its trajectory no longer appears unchallenged. In this context, interventions linked to oil producers take on a defensive character, aimed at preserving a system under strain rather than expanding one at the height of its power. The urgency surrounding Venezuela reflects this altered balance. What makes the current moment particularly unstable is the speed at which these mechanisms can adjust. In the analog era, changing reserve composition or trade invoicing took years of negotiation and infrastructure development. Today, digital systems allow for rapid shifts once political decisions are made. This compression of time magnifies risk, as feedback loops between energy markets, currencies, and capital flows accelerate. A disruption in one domain can cascade through the entire system with unprecedented velocity. Venezuela's experience also highlights a structural asymmetry within the petrodollar order. Oil producers bear the currency risk of holding dollar assets, while consumers and financial centers reap the benefits of stability and liquidity. When trust in the dollar's long-term value erodes, this asymmetry becomes harder to justify. For states already facing sanctions or political isolation, the incentive to exit, even partially, increases. Venezuela did not create this dynamic, but it has become a case study in its consequences. As the world edges toward a more multipolar financial system, the mechanisms that once seemed immutable are increasingly contested. Petrodollar's power lies not in law, but in collective behavior sustained by habit and enforcement. Venezuela's challenge, born of necessity rather than theory, reveals how fragile that behavior can become when circumstances change. The question now is not whether the system can be challenged, but how often and by whom before its foundations begin to visibly crack. Behind the visible drama of sanctions, oil shipments, and diplomatic standoffs lies a dense web of institutions that quietly enforce the dollar-centered system. The U.S. Treasury, the Federal Reserve, and a network of allied financial regulators operate in coordination with global banks, clearinghouses, and insurance markets that settle the vast majority of international trade. Access to these nodes determines whether oil can be shipped, insured, financed, and ultimately paid for. Venezuela's isolation was not achieved through a single decree, but through the systematic closing of these gateways, making normal participation in global markets increasingly difficult. Sanctions became the primary instrument of this pressure architecture, evolving from narrow trade restrictions into comprehensive financial exclusion. Venezuelan state assets abroad were frozen, access to dollar clearing was curtailed, and foreign firms faced secondary sanctions for engaging with Caracas. These measures were justified publicly as to us to promote political change, but their deeper function was to demonstrate the cost of operating outside U.S.-aligned financial channels. In effect, Venezuela was transformed into an example, a warning to other resource-rich states contemplating similar paths. What distinguishes the current phase from earlier episodes is the scale and normalization of these tools. Financial sanctions, once considered extreme measures, are now deployed routinely across multiple regions, from Iran and Russia to smaller economies, with limited global impact. This expansion has altered the cost-benefit calculation for many countries. While sanctions can be devastating in the short term, their overuse incentivizes the creation of parallel systems designed to reduce exposure to U.S. leverage. Venezuela's prolonged experience has provided both motivation and data for these efforts. At the same time, global power structures are no longer as asymmetrical as they were in the 1990s. China's rise as the world's largest energy importer and a major source of financing has changed the landscape for oil producers under pressure. Beijing's willingness to engage in long-term supply agreements, infrastructure investment, and alternative settlement arrangements offers a partial escape from dollar dependence. For Venezuela, these relationships became lifelines, allowing oil exports to continue even as all markets closed. Russia's role has also been significant, particularly in demonstrating how sanctioned economies can adapt under sustained pressure. Through discounted energy sales, non-dollar trade, and the expansion of domestic payment systems, Moscow has shown that exclusion from Western finance, while costly, is not necessarily fatal. These adaptations resonate deeply with Venezuelan policymakers, who see in them a roadmap for survival. Each successful workaround weakens the deterrent effect of sanctions and accelerates experimentation elsewhere. The acceleration of these dynamics is evident in the changing behavior of global institutions themselves. Energy traders increasingly hedge political risk by diversifying currencies and counterparties. Shipping companies and insurers seek structures that reduce exposure to sanction regimes. Even within allied nations, there is growing concern about the long-term implications of a system that ties financial stability to geopolitical alignment. Venezuela's case, once viewed as an anomaly, now fits into a broader pattern of fragmentation. This fragmentation places enormous strain on the petrodollar's enforcement mechanisms. Maintaining dominance requires constant monitoring, compliance, and intervention, all of which carry economic and political costs. As the number of exceptions grows, the system becomes more complex and less efficient. undermining the very stability it was designed to provide. The pressure applied to Venezuela thus reflects not only its strategic importance, but also a broader effort to slow a process that appears increasingly difficult to reverse. In this environment, the power struggle surrounding Venezuela is less about restoring a previous order than about managing its transformation. The institutions that once operated invisibly are now thrust into the spotlight, their actions scrutinized by governments seeking lessons for their own security. Each escalation tightens the feedback loop between enforcement and resistance, pushing the system toward a tipping point. Whether that point results in reform, fragmentation, or rupture remains uncertain, but the pace of change is unmistakable. Venezuela's story ultimately forces a confrontation with a reality that global finance has long postponed. No monetary system built on power alone remains stable forever. The petrodollar was never merely an economic convenience, but a geopolitical arrangement that thrived under conditions of American primacy, energy scarcity, and limited alternatives. As those conditions erode, the system's reliance on enforcement becomes more visible, and visibility breeds resistance. Venezuela did not break the petrodollar, but it revealed the stress fractures forming beneath its surface. The central lesson is in that the dollar is about to disappear, but that its role is changing in ways that are difficult to control. Reserve currencies do not fall in dramatic collapses. They fade through 1,000 adjustments in trade, reserves, and behavior. Each oil shipment settled outside the dollar, each sanction, workaround successfully executed, slightly alters expectations. Over time, expectations shape reality, and reality reshapes power. Venezuela's persistence under extraordinary pressure has altered the psychological landscape of global finance. For decades, the assumption was that exclusion from the dollar system was synonymous with economic death. That assumption now looks less absolute, even if costs remain severe. Survival, rather than prosperity, has become the proof of concept, and in geopolitics, proof matters more than rhetoric. Other states are watching closely, not to emulate Venezuela's path, but to understand its implications. The intervention surrounding Venezuela's oil sector thus reads as a defensive maneuver in a much larger transition. It reflects an effort to preserve a monetary order by reinforcing its boundaries at a moment when those boundaries are increasingly porous. Yet, history suggests that systems relying on constant reinforcement eventually exhaust themselves. The more energy required to maintain dominance, the less surplus remains to innovate or adapt, accelerating the very decline such efforts seek to prevent. At the same time, the emerging alternative is not a clean replacement, but a fragmented landscape of overlapping systems. Regional currencies, bilateral agreements, commodity-backed trade, and digital settlement platforms coexist uneasily, introducing complexity where uniformity once prevailed. This fragmentation carries risks of its own, from reduced liquidity to increased volatility. The world Venezuela points toward is not necessarily more just or stable, but it is undeniably more plural. In this plural world, oil retains its strategic importance, but its role is no longer singular. Energy transition, technological change, and shifting consumption patterns complicate the simple equation that once tied oil directly to monetary dominance. The petrodollar's power rested on oil's universality. As that universality weakens, so too does the currency architecture built upon it. Venezuela's vast reserves, once a guarantee of relevance, now sit at the crossroads of old power and new uncertainty. The final truth revealed by this struggle is that monetary systems are social contracts enforced at scale. They endure as long as participants believe compliance serves their interests better than exit. When belief wavers, enforcement fills the gap, but only temporarily. Venezuela's defiance, born of crisis rather than design, has exposed the limits of enforcement in an interconnected world where alternatives, however imperfect, are multiplying. As the dollar power struggle continues, the question is not whether the petrodollar will end, but how it will evolve and who will bear the costs of that evolution. Venezuela's experience suggests that transition will be uneven, contested, and deeply political. It also suggests that the era of unquestioned monetary hierarchy is giving way to one of negotiation and adaptation. In that sense, Venezuela stands not at the margins of history, but at its leading edge, illuminating a future that is already taking shape.